Welcome to the Lucia Capital Group weekly video. Let's think about what we've seen in the market so far this year. On February 19th, the S&P 500 hit its highest point in the previous 11-year-long bull market. Then the bull market ended after dropping more than 20% from the previous high, reaching its low point for the year on March 23rd. From there, it bounced back up and beyond its record highs and hit all-time new highs in mid-August. Now that's volatility. Of course, a little volatility can be a good thing in the world of investing by potentially taking advantage of it through dollar cost averaging. But too much can eat into your returns through something called volatility drag or volatility drain. It comes down to this. All else being equal, the more volatile your return stream is, the lower your compound rate of return will actually be, because it affects the way your returns compound over time. Let's take a hypothetical example. Investor A has $100,000 and earns 10% a year over 2 years. Her mean return is 10% per year, giving her a cumulative value of $121,000. Let's compare that to Investor B, who also has $100,000 but earns 30% the first year and then loses 10% the second year. The person's mean return is also 10%, but they're left with a cumulative value of only $117,000 at the end of 2 years. Investor A earned a 10% compounded rate of return, while Investor B only earned 8.2%. The difference came about because of volatility drag, the negative impact volatility has on returns. Now, this is where active management may really work in your favor. With passive investing, you own all segments of the market, which includes highly volatile, expensive, and low-quality portions. With an active approach, though, a manager is required to have policies and procedures in place that not only pay close attention to risk, but also make sure the portfolio lines up with your investment philosophy and the goals of the client. Because the active manager puts a high priority on risk management, the manager can decide which asset classes or securities may provide a better return for the amount of risk being taken. And by the way, potentially choose not to invest in an expensive or highly volatile asset. In other words, reduce unwanted volatility. Now, two important takeaways here. First, volatility in the market will always be there. And second, risk management may be the most important factor in any investment environment. If you don't have a strong risk management approach to investing, the volatility could cause serious harm to your portfolio. Now, with all the ups and downs we've seen in the markets this year, right now may be the best time to review your portfolio for risk, and let's see if it lines up with your goals and tolerances. At Lucia Capital Group, we do this every single day. You need help? Just give us a call.